80% of the time, stock goes nowhere in a range. Most traders lose money trying to pick a direction. But there's a strategy that turns this range into income, collecting premium from both sides simultaneously. I placed over 200 of these trades since 2018 with a 90% win rate. Today, I'll show you the exact setup, the entry, and how to manage this trade. So let's get started. Welcome to this 3-part series. In the first part today, I'm going to talk about the strategy itself, the basics of it. We're going to talk about the Greeks and when and how do you trade strangles. Let's start by talking about why should we use this strategy? What are the advantages? This is a repeatable strategy to collect immediate premium income. So when you open this trade, you're going to collect the premium immediately. It's going to get deposited into your account right away. It's cash. You can withdraw it. You can use it on another trade. You can do whatever you want on it. And that's the beauty of this. You also want to use this strategy when you want to earn passive income every day through theta decay. Just like short puts, every day your position will be decaying in value, and that's good for you. So this is a very hands-off. Once you open it, it's said and done, and you just wait. It's a waiting game trade. I really like strangles because it doubles the premium collected compared to selling short puts or short calls. And the reason for that is because you are selling 2 option contracts, so you're collecting double the amount of premiums for the same amount of margin usage compared to selling a put or selling a call. The buffer for error is huge. This is actually my favorite part of it. A lot of the time, when we choose a direction in the stock, we get it wrong. And most of the time, stock trades in a range. So this strategy is basically hoping that the stock doesn't move at all or it moves very little. So there's no need to guess the direction of the stock. And that's why the win rate is 90% plus. So let's move on. Let's talk about what are short strangles. Short strangles are shorting a call and a put at the same time. So you're going to short a naked put, plus you're going to short a naked call. And when you combine it, the analysis tab, which I will be showing you guys later in Tasty Trade, it's going to look something like this. Basically, this green part, trapezoid, if you land between the put and the call, you're going to make the max profit of this trade. Now, if the stock moves above the call or below the put, you might start losing some money. When it breaches past your put strike minus the credit collected, or if it breaches the call side, the strike price plus the premium collected, you'll start losing money and you'll go into the red zone. So let's talk about the Greeks for this short strangle strategy. It is a delta neutral strategy. So we do not have any direction bias, which means we're expecting the stock to trade in a range or go nowhere. This is a strategy for ranges, which happens all the time. As Albrook says, 80% of the time, a stock, a future, any instrument is usually trading in a range. Let's talk about the Vega. It's a negative Vega strategy. So we profit when the IV drops, the implied volatility drops. And what that means is we want to open this trade when the IVR is relatively high. So IVR should be over 30. This is ideal. Theta wise, it's a theta positive strategy. So every day the premium decays. The extrinsic value will get lower every day. Whether the stock goes up or down, it doesn't really matter. And that's the most important part of it. So you'll be making money in your sleep. Okay, sounds good. We know the basics now. We know the Greeks. But when do we actually use this strategy? As I said, we use it when it's in the range. So I got a beautiful example right here of a very nice range. I drew a purple box to illustrate the range easier. The EMAs, the yellow and teal line, we can see it's going up and down. We got the gray dots here, going down, going up, going down, going up. So that's another indicator that tells us the direction is neither up or down. It's going nowhere. We can also visually see the stock is just bouncing up and down in a range. RSI is right in the middle, around 50 for a very long time. So it's neither overbought or oversold. I like that. The IVR is elevated. It's around 80. And that's beautiful because later on when the stock calms down, we're gonna make money from the volatility crush. Let's talk about the profit and losses. This strategy does have a max profit cap. It's capped at the premium collected from the put side and the call side. However, max loss wise, the risk is undefined, especially the call side. Because in theory, if the stock goes to infinite, you can lose an infinite amount of money. Now, that's theory because we will stop out way before that. And I will be talking about the stop loss rules later on. Now, on the downside, on the put side, you can lose as much money as the value of the stock at 100 shares. But again, we're not gonna wait until the stock crashes to zero. We're stopping out way before that as we have rules. So these are just theory, but it's something to be aware of. Let's look at some live examples. I got SPY open here right now. I'm gonna sell a 15 delta strangle. This is just an example. So right here, 15 delta, 690. And I'm gonna go to the call side and also look for the 15 delta strike, which is 789. Let's look at the P&L chart. So we collect $4.62 on the put side and about $3 on the call side. The total is about $755 for this trade. The max amount you can earn is $755. If on expiry, the SPY stays between 690 and 789, between these two flags, these two red flags. If we go 7.5 points below 690, we're gonna start losing money, as you can see right here. It turns red. That's the break-even point. And also we have a break-even point on the top side at 7.5 points above the call strike, which is around 796 points. And we'll start losing money. You can see the red when we go above that. We can also see over here P50, the probability of hitting 50% of the max credit is around 90%, making this a very high win rate strategy. We can also see the max loss right here is infinite. And again, that's theory. I already explained it. Do not worry about that too much unless you get hit by a truck and you can't close the position in time. But don't worry about that because that's theoretical. We're going to be closing that trade way before it gets that serious. And you can see this is a Vega negative strategy. So for every implied volatility point going down, we're going to be making about $135 for every point. Also, theta is $20. So we're going to be making $20 every single day, even during our sleep. The delta is 0.29. That's very close to zero. Very good. So there's no direction bias in this trade. We don't want a direction bias. We don't want it to go up or down. But as you can see, we can go up and down. It's okay as long as it stays between these two red flags. I'm going to be opening up a chart of SPY right here. And our strikes were 690 and 790. So I'm going to draw a box showing you how big this range actually is. 690 all the way to 790. So as long as SPY trades within this range, by the time it expires, we're going to be making $755. Okay? And the most important part is you can see how big this box is. So that's why the win rate is very high, around 90%. We have a lot of buffer room to go up or down. And of course the best is it goes sideways and goes. So I hope this illustrates and gives you a feel of how big the buffer for error. I'm going to go back to a tasty trade and just review quickly how we actually trade this strategy. I might have done it a little bit fast when I was talking about the P&L, so let me just go back. We're going to be selling an out of the money call. You can see this is selling because it's red and it says S. Okay, so we open one of those, and also we're going to go out of the money on the put side, and we're going to be selling, make sure it's red and S. We're going to be selling one of those puts too. So that's it. You're selling a put and call on both sides, very far away from the middle price. It is that simple. Pay attention to your margin usage. Okay, we should use only a max of 5% of our net lick in buying power. If your account is, say, 200,000, okay, 5% of that is about 10,000. So you can use 10,000 of buying power for one of these strangles. In this case, 11,000, that's close enough. Next lesson, I'm going to be talking about how to choose a good stock, what makes a good candidate to trade these short strangles on. And I'm going to be going through how to choose the best strikes and the best time expiration. So basically, I'm going to go over how to choose the best option contracts to trade this. All right, traders, trade small, trade safe.